The Trump taco trade, as in Trump always chickens out, on tariffs that is, has finally come to light. Trump was asked point blank what he thought about this in a press conference today, and responded with a classic,
"What you said, that's a nasty question. Go ahead."
And on cue, the market slid about 20 points lower. But have no fear, NVIDIA earnings are here, and so far post-market things are looking pretty good with a double beat and raise, as well as some clarification in regard to China restrictions. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY daily time frame chart, and we're intentionally leaving the chart zoomed out so you can see some of these prior reference points here, the bottom end of the overhead supply level, 588.75, as well as the last major lower high before the downtrend really began to accelerate at 599.25. But before we get too deep into the levels analysis, let's just talk about the daily base case. Remember that we have lows, firm higher lows, soft higher lows, soft higher low, soft higher low. I don't know about you, but Friday is ultimately looking like the next firm higher low in the daily trend count. Remember, to accomplish a firm higher low, the hourly trend needs to flip to down, and we need to be pulling back from the highest high in the trend count, and both of those conditions were satisfied on this pullback, literally from the highest high. After poking over the overhead supply level, we came back down underneath and perfectly supported off of the daily 200 SMA, the green moving average on our screens here, as well as the top end of the China gap at 577. So is there a logical reason as to why buyers may have stepped up there? Absolutely. And the trend remains in the upward direction. Now, the next big thing you'll hear in terms of bear calls online is absolutely that this has to turn into a double top and it's going to be the end of the world. Well, first of all, in the after hours, given what's happening with NVIDIA earnings, the market's trading higher. It's at 589.66 by 46. Let's just split the difference and call it 589.50. That's over the overhead supply level here at 588.75. If this was going to be a more firm rejection, the bears ideally wanted to see an open on a slight gap down, or at least just underneath 588.75, and as of right now, that's not the current case. But even beyond that, if this is going to turn into a double top, that is fine. But where does the double top actually trigger? And we're so adamant about this here on the channel, because if you're trading this based on the premise that you think it will turn into a double top, that's completely wrong. It only turns into a double top. This is only a lower high double top trend reversal when the lower low is brought into the market via a breakdown of the neckline, which would require price acceptance underneath 577. As of right now in the post-market, with the move higher, it seems less likely that we would be opening for a potential threat to trigger the double top, as opposed to, let's see if the market can make it back up to the equal high, which affords the market another opportunity to pull back and set another higher low. Ultimately, what that does, right, is you start building out some degree of an ascending triangle, a wedge, whatever you want to call it, it doesn't matter. But if you have soft higher lows, firm higher lows, maybe a firm higher low here, a soft higher low would also work. Equal highs, what do we know about uptrends? If you're in an uptrend, the momentum is up, it's being supported at the exchange level, you're usually looking for equal high breakouts. And if we have a flat top breakout level, I would easily expect, or I shouldn't say easily, but my expectation would be that the odds, let's speak in terms of percentages, right? The odds would favor a break through the equal highs to get to the next target, if not go through that next target and seek the next major level, which in this case happens to be the all-time high at 613. Now, I'm not talking about getting to the all-time high 613 into the end of this week, but that's the sequence in terms of counting and following this daily trend that I'm really looking forward to over the next couple of trading sessions. It could be the end of this week, all the way through next week, so on and so forth. If the market is going to pull back more aggressively, as I've said, it's okay to find a soft higher low. The hourly trend may not officially flip to down inside of this area. A soft higher low on the hourly in here is fine. Equal highs would then prevail. The trend on the daily remains intact. And if the market is going to yield the double top that everybody's maybe a little bit nervous about, that's fine. We'll trade it when and if there's a breakdown underneath 577, which is acting as the neckline, along with confluence, again, that daily 200 SMA. And I'm honestly not all that excited about trading the downside there. I think there's the possibility of a gap close here into the China gap close, which is at the 567.75 mark. But when we get here, I'm more interested in also giving the buyers the benefit of the doubt from the weekly perspective Is there a weekly higher low that's going to form here? Is there the opportunity to support over that level and then Brigade bolt back over 577, then make it back to the equal highs? I would maintain much more of that bullish stance here, even on a gap fill reversal over 567.75. So let's not get it twisted. Let's go down to the hourly time scale here. Let's get a little bit more granular. It doesn't mean that we can't trade the market short. We absolutely can trade the market short. It's just a matter of how aggressive we are on the short side and if we're overstaying our welcome at targets. So on the hourly trend here, you can see if this is our daily high or low, right? Let's just label this DHL shipment. There we go. Haven't said that in a long time. DHL shipment is finally in play. That means that the hourly trend reversal here is in service to the daily high or low. Any hourly higher lows, remember I was saying we could get a soft, arbitrary higher low? Well, now that we've brought in the hourly levels, you could build the argument that even if the market opens underneath that overhead supply level 588.75, and again, here we are post-market, slated to open above that level. But if we do open below, that's fine that the market might actually come in here. It might test something like 585.50, 584.30, which is the low of the Tuesday session, which we'll talk about the gap here in just a second. That would be a great spot for an hourly higher low, which wouldn't really count as a daily higher low again. So we'll label this soft daily higher low. And then we'll also label it firm 1 hour, let's say 1H and then higher low, would prevail over this area at 585.50. I would be looking for reversals here to then Brigade bolt here and just walk up the target to the equal high. This is ultimately what the market's trying to navigate back towards because this is the highest high in the daily trend count up there at 595.15. So base case is starting to look like this. If I draw on the pathing, then we'll talk a little bit more about this gap here. If we open above 588.75, this is just bullish consolidation outright. There's nothing wrong with that. Obviously, you're over this level here. This is no longer overhead supply. What we had off to the left is no longer overhead supply. This looks good. Brigade bolts over 592. Target the equal high at 595.15. Beyond that, as we talked about on the daily, we're looking at 599.25. Right? So your pathing on that is as follows. Bullish consolidation here, Brigade bolt above, target this, walk them up, next target overhead, 599.25. That's great. If the market opens and consolidates here, this is perhaps a trade. You could look for a short from point A to zone B. Let's just call it zone between 585.50, 584.30. But when we get to 584.30, once again, my top priority is can the market support above that for an hourly higher low, low, higher low here? Can we get the rotation back over the overhead supply level and then continue that same upside pathing that we were just talking about? Remember, the name of the game here is to be a buyer of pullbacks. We're trying to long pullbacks in a daily uptrend as well as an hourly trend reversal here, right? We know that if this ultimately is going to be the inverted head and shoulders, any right shoulder can basically persist over the gap close. So that brings me to my next trade, which is, as we mentioned a second ago, we can short the market here in the short term, but I'm not overstaying my welcome. If we get something that looks like this and a Brigade bolt to the downside, I'm trimming in like 3/4 of the position and reevaluating at 585.50. And if the market goes through, great, we can balloon some runners into this next area. If the market produces a short setup here as well, you could take a new short under 584.30 into the full gap close at 581.50, but I'm reevaluating at the 581.50 as well. I'm saying, okay, I should be trimming something like 3/4 of my position and reevaluating whether I should stop out of all of the runners and change tone back to the long side, because we know that this as well, let's just draw on the complete path here, this consolidation yields a short trade, let's just say from here to here. This yields a short trade from here to here. When we get to that 581.50, it's all about how do we find the 15-minute reversal to set the hourly higher low, right? From here to here, now you're dealing with an hourly higher low. And in my view, that's in service, once again, to the daily trend remaining in the upward direction, which sort of acts as the home base, which is why we call it the base case in the first place. So these are the sort of pathing ideas that I would mostly be interested in from an open over 588.75. If I had to rank order them, the strongest opportunity is this, right? Because on today's late day breakdown, you trap new money shorts. Anybody who's going to squeeze and pinch out of this thing tomorrow is gone over 592. We walk up that target to the equal high on the daily, and then we keep going from there, right? Something along these lines. So this would be like primary number one. Number two would probably start to become your shallow pullback for something that stays over the gap. Remember that if this gap does not close, let's talk about this gap right here, it would just be an indication that sellers are not strong. Keep in mind that on the Tuesday open, technically speaking, we opened at a location right here where it was very possible that the hourly sellers, the hourly bears, could have produced just an equal high, right? And then maybe the trend would have remained neutral, if not had the opportunity to remain down if markets closed the gap all the way and fought for acceptance inside of Friday's range here. Obviously, that didn't happen. So the question becomes, do we have stronger sellers in the market? The answer is no, based on Tuesday's rally and based on today's end-of-day breakdown, which is already being retraced in the after hours thanks to NVIDIA's earnings, right? So this would be pathing number 2 as an outcome here. If the market opens on a move underneath, let's just say that this completely fades by the time the market opens up for Thursday, and we open on a move down here, I would be not interested at all in shorting this into the top of the gap. I would be more interested in patiently waiting through this drawdown for a full test of the level and then reversing course to see if we could find this trade back in the upward direction. Where I really start to favor shorts, as you guys could probably tell from the daily timescale, is, and again, you could open here, you could fully fill the gap, you could get a higher low over the Tuesday low. That would be a great example of a Brigade Bolt recapture over the level at 584.30. That would be a long here for risk reward, right? But where I really start to become more comfortable on the short side and looking for follow through to the downside, getting a little bit more aggressive, is if this gap does not produce a reversal. If we find a lower high here, now I'm thinking about, okay, wow, we have the opportunity for some kind of lower high on the daily, right? You could draw that in. We never made it back to the equal high. You've got your low of the neckline from the double top. And if we have an hourly trend reversal back to the downside as well via some sort of hourly lower high underneath 581.50, that's where I'm really open-minded saying, okay, we should not be retesting the daily 200 SMA in such short proximity of time. I'm very open to this short here through the remainder of the China gap underneath 577 into something like 567.75. So that's how I'm viewing the market as we head into the end of the week, primarily leaning into that daily base case that the trend remains in the upward direction, that the buyers are in control here. The upside comes first, and I'll change my tone when and if there seemingly is price acceptance underneath 581.50. Let's come in here with the Fibonacci's. What we care about, in my view, is from the top to the pullback low. Are we over the 61.8? The answer is yes. Look at this beautiful confluence right at the overhead supply level. So once again, if the market can sustain and open over that level, the odds of a 100% retracement are dramatically increased. So 588.75 being reinforced via the fibs there, 38.2 kind of in between the gap, not really all that influential on the downside. If we come in here with the anchored VWAPs on the intraday, what else can we learn? I mean, come on, it doesn't get any better than this. You have anchored VWAP from the low, supportive towards the lows of today's session, the gap up from the China pause. You have the high of the move when the retracement started, the hourly trend turned it down. You can see resistance here, right? We're using that group, this cluster, as newfound support. So as I evaluate the data points, as we evaluate, okay, this gap didn't close all the way, who has the edge in this market? Well, in a daily uptrend after forming a daily higher low supportive over the daily 200 SMA, I personally tend to side with the buyers here. Think about it this way. You could look back and ultimately, if in like the next 5 years, this ends up marking the low of the pullback and markets go on to produce brand new all-time highs, personally, I want to be able to look back at this moment and tell my grandkids someday, yeah, you know, Grandpa Matt here was able to buy with both hands the daily 200 SMA on the retest because the daily trend was up and he didn't, play games and say, I'm scared of the pullback and oh no, Trump tariffs are going to bring the market to zero, right? And so be it, right? If the market does end up breaking down underneath this, Grandpa Matt is also going to say something like, hey, the lower high told me that I should probably button things up on a neckline breakdown of the trend reversal, right? So either way, this is what I'm looking at. The base case supports the buyers being in control. I'm not going to speculate about my future self anymore, and let's move along into our market internals. If you're not familiar with this dashboard, take a look at the top right-hand corner of your screen. It's a video tutorial there. And you can learn more about the dashboard. This is the holy grail of market context. We've only got 2 sessions to really evaluate, and what I would really focus on most here is the Tuesday session. Did we see strong buyers step up on Tuesday when the market was making that steady and slow grind in the upward direction, gapping up from Friday, right, through the holiday weekend? The answer is yes when it comes to volume flows. The answer is yes when it comes to the advanced decline line. The answer was yes when it comes to trend score here, index score basically. Intraday, it was reading very strong up and over the 20 handle. And then down here, the cumulative tick was also strong. As the market pulled back today, I would ask the inverse question. Did stronger sellers step up and unwind the activity that was taking place on Tuesday? No, we did not have substantial volume outflows. we got close to trend lower zone, but we didn't fall into it, and the index score never actually got substantial underneath negative 20 during today's session. The cumulative build on the tick is a little bit more even-keeled in terms of unwinding the Tuesday action. However, you can see if I just zoom in on this a little bit more firmly, there's a little bit more time spent above the zero mark here relative to the time that was spent under the zero mark on the Tuesday session. So in my view, in aggregate here, we still have stronger buyers at the exchange level participating in the rally on the gap up from that Tuesday morning open. Let's jump on over to the market profile and let's take a look at what we can glean from this information here. So this is Tuesday's session. This is the shortened session from the holiday on Monday. For the most part, you get a P-shaped profile on Tuesday, which is indicative of short squeeze if you're just looking at profile. But given what we saw on the market internals, I would argue that this is actually new money buyers stepping up at the exchange level as well. It's a combination likely of the two of them. You can see value is higher in the session. Point of control is higher in the session. On today's session, M period singles down at the lows. Look into the post of the P-shaped profile. Again, here's your P. We look into the post of the P and M, and already the market's rebounding through the after hours. And you could say, oh, no, it's NVIDIA that's saving the market. Well, I mean, so be it. What are you going to do about that? Are you going to remain short even though NVIDIA is telling us that, okay, the market seems to be auctioning higher in the after hours? To me, this M period excursion into the single prints and the post of the P is being rejected. And once again, this aligns with the analysis of the market internals we just conducted that really don't suggest we have stronger sellers stepping up at the exchange level. If we're evaluating value on today's session, it's smack in the middle of the session, as is the point of control. Very balanced, very, normal curve. If you were to draw a bell curve, right, this is almost a perfect example of that, where there's not much to glean from that. There's decent excess in A period, decent excess in M period. There's no poor highs or poor lows to repair. It looks good. It honestly looks good for price acceptance at a higher level, and it just becomes a matter of on the price charts, if we go back here to the Spider's Cash, do we open over the 588.75 or under? If the open is above, once again, price acceptance above, as we saw from the market profile via value being in the midpoint of the session, that's basically here on today's session, I would think the next excursion is in the upward direction to align with everything we've discussed so far in today's episode. With that, let's take a look at our next victim, which of course is going to be the nasty NASDAQ QQQ daily timescale. What do we see here? Let's zoom out so we can see the reference of the 509 previous area of support here acted as resistance on the breakdown. Notice that the gap down on the Friday session of last week went to the level, and so far it's immediately back above, right? There is no, in terms of overhead supply like what we had in the S&P, it's not like we're doing that dance right on the cusp of the level in the NASDAQ, which inherently is more bullish, right? You have to remember that the tech sector makes up over 30% of the S&P these days. This is bullish in terms of the way that the two indices are, giving each other interplay, I suppose you would say, on the intraday, just on a relative strength basis. So with that, there's really nothing bearish to read into. There's the same firm daily high or low. We finally flipped into an hourly downtrend. The gap up is holding as of the Tuesday low. You can see that there was a mild pullback off the top end of the range in here, which is totally to be expected and normal. We talked about this in the pre-market prep this morning, actually, where if the 5 or the 2-minute time frame chart could not yield some sort of clean high or low above, the look above and fail was actually more likely, right? Which is fine. Like, that's not going to change the daily bull base case. It just means that the breakout isn't ready yet. And if this is going to act as an hourly high or low from here to here, and if the NASDAQ is inherently higher through the post-market already at 522.50s, which is the exact high of the range in here, certainly sets us up for shorts who are late to the party here, getting squeezed out tomorrow morning on a breakout over that 522.50. So for all intents and purposes, on the NASDAQ, buyers are still in control as long as hourly high or lows stay over the midpoint of the range, which also is confluence with the Thursday high of last week at 517.50. You could do a number of things here. You open at the top end of the range. If the market pulls back again, that's fine. As long as the consolidation is over that 517.50, great. You have that high or low. The next attempt would be a Brigade bolt over 522.50 into 525.50. Next target 527.85, and then it really opens up. This is where there's, quote, free air above. Like, I'm not going to call it a blue sky breakout until it's actually all-time highs, but in here, there's quite a ways to go. There's like 6 points, give or take, maybe a little less, 5 points, between that 527.85s and 533.25s. That's really a next solid range to be trading through. So those are the upside levels. If the market is going to break down a little bit more firmly, I would need to see some sort of price acceptance underneath 515. So I'm not even really that bearish underneath 517.50. Yeah, is that the ideal hold? Yes. But underneath 517.50 is kind of consolidation. I would only be short for a gap close to the downside into 511.85. And then, as we've said in the S&P, although you're underneath what could be considered the overhead supply here, I'm still willing to give this a little bit more room to produce, right? A higher low from here to here. I would probably get more aggressive on this just to come in with the pathing, right? Let's say that this, let's go front and center with this QQQ price action. Let's make sure we're not like hardly being able to see the screen here. If we come down, put in the consolidation, maybe there's a gap close trade here, under 515 into 511.85, fine. If we go gap fill reversal, let's say it's a double bottom, whatever, we get more aggressive on the recapture of 515 and we rotate back to the top end of the range. That's a classic look below and fail on this balance range here. This is the look below, this is the fail back into the range, this is the target, the opposing end of the balance. If we go beyond 511.85, that's probably where I'm like, okay, now I would be more open-minded to this, acting as the threat and really seeking some kind of lower high underneath 515, continues to produce all of this as overhead supply, trapped longs from this range. That becomes a little bit more detrimental. And then honestly, just like the S&P, how do we define this as a double top? It would have to be where? Underneath the neckline here at 506. So there's quite a lot of work that needs to be done if the sellers are really going to make a stand and confidently produce a trend reversal from the daily time frame, or I should say from the hourly time frame that ripples out to the daily time frame via something that, as we've said, kind of goes here, beyond it. If we're consolidating, even a lower high there starts to become a little bit more concerning. But again, notice where we're opening, or at least the scheduled open as of the post market on NVIDIA earnings. It's right up here. I'm not thinking that we need to run to the hills tomorrow and say, okay, duck and cover, it's going to get nasty. Could that happen? Of course, anything can always happen in the market. But again, thinking in terms of probabilities, I would tend to think that consolidation here to Brigade Bolt in the future is fine. Some sort of, opening drive that pulls back suggests a higher low over the top end of the range, targets high of day. Then beyond that, we go to the next target at 527.85. Beyond that, we know there's that free air to 533.25. That's kind of more where I'm thinking the odds favor some kind of continuation on a break through this, right? Because remember, just like we talked about in the S&P analysis, in a daily uptrend, at a certain point after producing a higher low, a firm higher low at that, over the daily 200 SMA, not even testing the China gap down here, with stronger buyers, as we've noted, based on the lack of gap close from the Tuesday open that was higher, I would think at a certain point in an uptrend, equal highs end up breaking out, right? They lead to the next higher high in the trend count. So that's how I'm thinking about the market here in the NASDAQ. We can come in with our anchored VWAPs and Fibonacci's just to be congruent. Obviously, like we're already at the 100% retracement. We're opening up here. If the market were to pull back, the 61.8, it's a little bit lower than that 517.50 level, the Thursday high. I would lean more so into the 517.50 based on candle structure and not just overshadow everything with the Fibonacci. Let's take that off and let's throw on the intraday anchored VWAPs. Perfect. Can't make it up. Can't make it any better than it already is. 517.50, key higher low hold on the hourly time scale. And keep in mind also that continues to preserve this kind of look here. Inverted head and shoulders. We can call it the mosquito pattern, whatever we want to call it, at 515. All right, so that is looking good on the NASDAQ. Let's quickly take a look at the NASDAQ market internals. You could see here that we have a similar story where there's substantial volume inflows on Tuesday, not as bad on Wednesday. In trend higher zone, near but not in on the Wednesday session, and the cumulative builds are fairly opposite in terms of strength and magnitude. If you look at the intraday action, much more bearish action here on the NASDAQ tick relative to the S&P tick, the NYSE tick on the open. A little bit more of a spread into the afternoon, but a little bit. Stop saying a little bit. More even-keeled back-to-back on the cumulative builds. How about that? Let's take a look at the market profile, and let's see what's happening from this perspective. Same story with the normal curve. Same story with the value and point of control at the midpoint of today's range. Value point of control higher on the Tuesday session. Acceptance higher. Notice that M period does not even look into the post of the P-shaped profile single prints from the Tuesday session. And once again, in my view, this just reiterates that buyers are in control based on this visual we have here with the added dimension of time from the market profile. Let's go back on over to the platform. Let's finish up the market indices with the IWM, Russell 2000, small caps. Let's see what's going on with the daily time scale. Over here, we have ourselves a much larger inverted head and shoulders that looks something like this. Of course, the neckline break would be a break through these equal highs at 209.25. We're waiting patiently for that, but for now, so far so good. Things are looking like we have consolidation after a higher low, as long as another hourly higher low is produced over the gap fill reversal, which is here to Friday's high at 203, the daily chart remains constructive in my view, and you could probably come in. I know we didn't use trend lines on the others. It depends on where you strike it from. If you do this, it's technically broken. If you use this as the new major low, which I would be in favor of because it's the firm higher low, as long as we're above that, which is going to kind of represent confluence at that 203 level into the end of the week and early next, I think we're all set on the daily time scale with the buyers to remain in control, even though, yes, the Russell is much more in a consolidation phase as opposed to some sort of breakout phase like what we have in the QQQ. It will be a powerful signal, though, I would imagine, for the S&P 500 should the IWM be able to clear that 209.25 and get into its daily 200 SMA and that 215.85 next up shelf of major resistance overhead. It is a thin structure breakdown on the way, so the 211.65, it might give a little bit of a reaction, but the big level is that 215.85. If things are going to get worse for the Russell, it would just be price acceptance underneath 203, basically the high of last Friday's session failing to hold. Acceptance here leaves all of this as overhead supply, and at that point, I think you're back in the scope of yielding a weekly, monthly, lower high threat around the 200 figure with a little bit of overshoot, of course, becomes much more detrimental when this breaks as a neckline, right? So we're not there yet. We don't want to jump the gun on the short side. What I do want to do quickly, though, just for the sake of taking a look, actually, is use the trend line on the other indices well above it on the NASDAQ. And if we take a look on the S&P 500 coming into here, perfect confluence. So lows, this is a firm higher low here at the trend line, which develops the trend line ultimately. And then this was also confluence. So I honestly was not really even looking or favoring that, but it is there, and another logical reason as to why the market's bullish so long as we stay over 577 on the S&Ps. Let's go back to IWM though, and let's finish up on the hourly time scale. Let's see what else we can glean from this chart. It's been a very simple balance range to navigate recently. On the breakdown in here, we've changed our tone to being a little bit more bearish. On the recapture, as soon as Tuesday opened, basically, things were right back on the bull side. How could you remain bearish if on the open from Tuesday, there was no lower high that was set to reject the overhead supply? Think about it like this. If you're a bear, what do you want to see here? Brigade bolt to the downside, lower high rejection here, and then make it back down to the equal low. As of right now, and as we've just described on the daily time scale, as long as we're over this level after producing an overshoot and a lack of rejection on the hourly for a lower high at 205.85, this now gives the opportunity for this higher low here. As long as we're over that 203, kind of good to go, looking for that trend reversal to favor the bulls more so than the bears. You're not getting as much love here out of the NVIDIA earnings, which is not a shocker. IWM is not going to have any exposure to that ultimately, and it'll lag in that sense. So not reading into NVIDIA earnings for smalls. Let's take a look at the anchored view apps intraday and see what we can see here. We're not above the entirety of the cluster. We're in the cluster. It would be best if we could clear this in the upward direction and firmly spend some more time over the 205.85. All of the pullback today was pretty mild up until the end of day, which is when that Trump taco trade thing kind of surfaced, if you will. If we can open above the 205.85, that would be best. As of right now in the post market, we're not really doing that. We're not seeing that. Depending on the size of the gap up from NVIDIA earnings, maybe there's just not direct sympathy, but just, a rising tide lifts all boats. If we can get above, that would give a little bit more confidence in terms of those VWAPs. If we're back underneath, I would expect another shot at that pullback to retest Friday's highs, where it's do or die, as we've outlined so far, at 203. If we come in with the Fibonacci's from the top of this move to the low, you can see the 61.8 is perfect at the 205 level, just reinforcing everything we've gone over thus far. Let's check in at the market internals level for the Russell side of things. Hardly any volume outflows on today's session, so firmly buyers in control at the exchange level. Not really exchange, there's no Russell exchange, but rather the index basket, if you will, was getting a lot of volume flow to the upside on Tuesday, hardly any on the outside today. If you look at the advanced decline line, same story. You're not really getting into or testing trend lower zone here. And the cumulative build out of the tick for the Russell, much stronger on Tuesday relative to today's read to the downside. Don't get me wrong, it's still going to take a chunk out if you were to sort of aggregate those two and look for the net, imbalance, but the buyers more so in control on Tuesday versus the sellers not as in control on today's breakdown. Let's jump on over to the market profile for the Russell side of things. And we'll take a look at what's going on from this point of view. Let's get a couple more days. I just want to be able to see Friday. There we go. So point of control and value higher here. Point of control lower and value lower on today's session. Once again, not unreasonable that the Russell, without sympathy for NVIDIA, may have some opportunity to stay underneath the level we were just talking about, that 205 mark in the IWM. If you wanted to see a equivalent on the RTY futures, you're probably talking about the closure of the singles from this day, which was Wednesday of last week, up around 2080, 2081, if you want to be very precise. If we're below 2081, 2080, which is right around in here, it's a mechanical level with value area high today. If you're below that, right, that's probably where the full gap close comes into force. And if we could stay over Friday's high, that's where we look for longs to at least support the narrative of the S&P moving higher. If we do not hold here around 2050, things probably get much more ugly for the broad market as a whole if small caps cannot at least find some sort of footing here. It's going to be more difficult for the broad market to move as a unit in the upward direction. Let's get back on over to the platform here. Let's finish up today's analysis for the broad market with the sector watch for our S&Ps. What do we see in terms of who was leading, who was losing, and where was the weight? Discretionary is leading the pack so far this week, up 87 basis points, followed by real estate, then communications. The tech sector is still green, as is financials, your top two heavyweight dogs in the S&P. At the bottom end of the barrel, it's utilities, which is D for defensive. It's risk off. It's also really lightweight, which makes sense, right? As the market's breaking out to the upside or trying to produce some sort of lift off of this daily high or low, it's a good thing that utilities are not leading the charge. We have energy, and then we have materials at the bottom end of the barrel. Excuse me. All of those are lightweight and risk off sectors, not concerned with the sector posture here. If we check in on the actual structural charts themselves, you can see that the XLY looks fantastic. If you recall from last weekend's update on Saturday, which feels like it was eons ago already, we're basically saying there's plenty of room for a higher low to form literally at the current close of Friday if we can support the China gaps, or if the gap closes all the way, gap fill reversal, right, still yields a higher low in the trend count. Notice that we've pretty much come into the equal high, which means once again, just like the S&P 500, I would not call this a double top reversal until we are underneath the neckline, closing the gap, and at that, I'm still willing to give the weekly a shot at that level in here. So if that's the case, I don't see how you could really maintain a more bearish stance out of the XLY. Consolidation here holds over the Friday high, very bullish with everything happening with NVIDIA. You're already higher on sympathy here and discretionary, 215 by 216.50s. Not bad, right? You're already talking about an open that's towards the upper third of today's trading range, and this is not even, NVIDIA is not in the XLY, of course. Let's move along to the XLRE real estate. With rates kind of trying to settle down, maybe, is that a reasonable thing to say? Not bad to see real estate remain inside of this balance range here. We're mostly concerned on real estate because it's a lightweight sector. When it makes a new swing high, when it makes a new swing low, that's when we say, okay, there's some pressure to the S&P, just in the midpoint of this range, nothing to say. Let's take a look at communications. Same old song and dance as what we said in the XLY. You've already produced the equal high. This is a higher low. It's not a double top until it is. You would have to break the neckline, and even at that, this level in here at 98.60 still could yield a higher low in my view, where I would not be willing to change tone ultimately and say, okay, wow, the bears are really taking control here. I'd still be optimistic about a possible higher low hold at that retest. If we just get consolidation up here, it's bullish, and then Brigade bolts up and over 102.70s look really solid for upward pressure in the S&P. XLK, the top dog, obviously, with NVIDIA inside of it. What do we have with a potential open? We're looking at 233.30 by 58, which brings us right around in here, basically towards the high of today's session. And all things considered, what's the trend, right? The trend is up. We talked about the higher low hold here, daily 200 SMA, no concerns. As long as we're over Friday's high, say we open here, fade the entire thing, and wind up at 226.75. If buyers continue to step up at the bottom end of what could just be considered now a new range that looks like this, no problem. If we get under the neckline, there's probably some shorts to have into the gap close, then we'll reevaluate at 219. I think that's really the way to play this market right now, which is just like totally bullish until proven otherwise. We've got a potential for double top if we break the necklines, but if we break the necklines, those double tops are short trades and keyword trades where we're not overstaying our welcome into the China gaps. That's really like the best way to frame the market right now, which is like stay on the long side, stay looking for longs. It's a risk-on environment. You could take scalps on the short side intraday, that's fine, whatever. But we only become confident in a major short trade unfolding if we're closing the China gap. When the China gap closes, if it closes, then we will really reevaluate for buyers because that's ultimately what the trends are telling us to do, weekly time scale. And then from there, if we do not hold here, that's where, okay, maybe there's a larger down leg in the market. And we, once the trend changes, will have more of an opinion on that. But that's so speculative as of right now. With an open tomorrow that's potentially up here, why would I be speculating about a full gap close to the China move and then a lower high underneath? Let's trade the chart in front of us, which is just if the market pulls back, support off the bottom end of the range. If the market just consolidates, this is a higher low here over the daily 200 SMA. This potentially sets up a soft higher low, and we'll look for an equal high breakout to get to the all-time high. That's the chart that's in front of us. Saying that, okay, this is going to produce this big failure here, and then, oh my God, it's going to go here, that's just falling into the total trap of panic and like speculation beyond reasonability or beyond what's reasonable in the near term. Financials, now that we're off that tangent, got that one off my chest. What do we see here? Great high or low, not quite at the equal high, all about 50-70. No influence from NVIDIA, of course. If this does consolidate here, just has to hold Friday's lows, not Friday's highs technically. I would like to see the hold there and then some sort of Brigade bolt to get follow through to the upside. We probably want to start tracking in here as well, something along that 51.65 as a potential hang-up spot given the local pivot high in the close of the, what was that, the 519 bar. So that's your next upside target. If we get follow through, look for that. Beyond it, of course, that's just upward pressure for the market. Generally, the trend is up. I'm more bullish on the XLF. Industrials, which seemingly dropped off the watch list. Thanks for the reminder email from you out there in the audience. You know exactly who you are. I really do appreciate that. I must have just totally like missed it one day and missed it for about 2 videos if I look back through the records. But same idea, already at the all-time high, looks great, high or low, no issues with this whatsoever. 8%, as we typically say about of the S&P 500's weight, no problems. Consolidation up here looks great. Give it a weekly bull flag consolidation, give it a breakout to blue sky territories, give it a pullback back here. I think we're fine. I do not see the issue or threat out of industrials. Healthcare, let's maybe speed it up through the back half of the sectors. Bottom end of the range really needs to hold. Although it's a D for defensive sector, we have to remember it's the 4th heaviest weight sector. You're continuing to get some, with the UNH thing that has not really recovered in a way that I think most people were hoping that it would. You're still seeing some pressures here out of healthcare. So if it can go ultimately, right, look below and fail, target the top end of the range, that, in my opinion, would fuel the S&P towards a breakout in the upward direction. What we need ultimately, if this broad market's going to break out of the range, I'm specifically talking about the S&P 500 breaking to a new high in here, then what you need is a day where financials are green, you need a day where the tech sector is green, and you also need a day where healthcare is green. If you have those 3 ingredients, and most of the time, if the tech sector is green, discretionary will be green, considering Tesla, Amazon are kind of in there, right? But if you get those 3 ingredients, which are the 3 major different buckets, I would kind of classify, given what companies are where, XLY, XLK, not that they're exactly one and the same, but you get my drift. If you get financials, tech, and healthcare all moving in the upward direction, that's the fuel it's going to take to yield some sort of new high here in the S&P. Or you're going to need a flat XLV, and you're going to need a screaming XLK rally. I'm talking about a day where tech is up somewhere north of 2% or something like that. So that's the recipe for success if you're seeking a new high. Let's take a look back at let's go to utilities here, sector-wise. Over the top end of the range, pull back, fine. Really not concerned with this. New swing high to all-time highs, if anything, would just be upside pressure. I'll say this. If the utility sector is breaking out to brand new record highs and the S&P is also testing its record highs, that would be a little bit of that red flag, right? A little bit of a red flag to see utilities fuel the broad market higher like that to a new high, specifically if the tech sector is lagging. That would be a big enough divergence where I would probably button up longs and start looking for active shorts on any trend reversals to the downside on the hourly, right? If we look at the energy sector, you can see we're back inside of this range, kind of unchanged ultimately. Still hasn't figured out in my view, what's going on here with the push and pull, right? You have AI energy demand, but then you have demand destruction potentially with the tariffs and the looming threat, as always, of like recession, of course. So I think those two things are at odds, and considering this balance range, I think that price agrees. Right? Can't really make up its mind up or down. Materials looking good for equal highs, really just a balance range in here, not much to say. Just like real estate, new highs versus new lows, swing highs, swing lows, breaking a balance range. That's where we get interested. So 85 and 87.60. One thing I will bring up is the XHB. We haven't looked at this in a little while, but what it has done, unfortunately, is started to close ever so slightly as of today's session back underneath the tariff turmoil highs, which does not really bode well, right, for the cyclical side of the economy. We all know that home builders have historically acted as a solid leading indicator of the market. So if I was going to make a bearish concession, it's absolutely home builders. A lot of people have been using ITB as well. ITB is even worse in the sense of, if you look at this, it's actually a lower high underneath. Let me zoom in even further on that. Here's the 90-day pause announcement, right? Lower high underneath that, rotating back towards the lows. You could call it a bear flag breakdown. So again, the bearish concession across the entire analysis here is really home builders not confirming any of the upside rally that we're seeing there. But, you know, personally, I think of the market as the ultimate source of truth. This is one data point across a number of sectors we've looked at already that suggest, no, we have an uptrend in the XLF, we have an uptrend in the XLK, XLY. Those things outweigh this singular data point in the ITB. So I would just caution anybody latching onto that one data point and thinking, oh my God, the market's got to crash, home builders are down. It's like, okay, it's one data point, right? Could it spread to more than just one data point? Of course it could, but we're not there yet. We're not there yet. And price is the ultimate, price is what pays. XLP, inside the range. If it breaks out, again, we don't want that fueling the S&P at the all-time high, so we'll look for a rotation among the sectors if that's happening. As of right now, a non-issue. Semiconductor is going to be a big gap up tomorrow via the NVDA earnings. Of course, after hours, 246.80 by 247.30s brings us actually outside of today's range. So looking good there. The primary thing that we want to continue to watch for is sustained holds. Let's say that the entire thing fades. Sustained holds of 237 keep me bullish on semiconductors. Why? Consolidation back inside of the previous overhead supply. Sellers were unable to yield a lower high underneath that. And in my view, if the sellers were going to do anything meaningful, right? We were already in a daily uptrend here, higher low, equal highs, breakout to a higher high. If the weekly sellers were going to say, nope, that's it, we're going to put a stop on this right now, let's put the kibosh on it, would have been right here. 237, big weekly lower high, roll back over, no hold of 211, something that looks like this. That's what the bears wanted to see. Did they get it? The answer remains no. Let's take a quick look at bonds before we jump into the sector ratios, just pointing out the recapture of the 85 handle. If you look at this, big overshoot, recapture, is it going to Brigade bolt back up to the highs? I would like that. Just to be transparent, I am still short some TLT puts down here towards I closed up the 80s on the rebound basically off the lows. Why not? I mean, they were 75% of credit received for profit, of course. So solid there, but still maintaining some of the further out. I'm going to see if I can get maybe more than the 75%. I don't want to get greedy on them, but at this point, if it just rallies higher, see if we can get something like 90% and then redeploy the capital some other time. For now, with the bonds though, coming back over the 85 handle, if this is going to turn into inverted head and shoulders, right, any upside here should, in theory, put some downward pressure on rates. Should bonds catch a little bit of a bid. So with that, we'll jump on over to our ratio grid. We'll see what's happening here. So this is the straight up sector ratios to the S&P 500. If you don't know how to set this up in Thinkorswim, check out the video tutorial in the top right-hand corner and let's go through. We've been talking about green shoots, so let's bring out the green crayon. This looks good. Green shoots still on an upward trajectory here. Bull flag, you could call it whatever, on the XLK. This is risk on green shoots. Same thing here in the XLY. This is a nice equal high here. Higher low is holding. So far over an upward sloping 50 SMA. Green shoots, green shoots. XLF leaves a little bit to be desired. XLV, a non-issue because it's a defensive sector. We don't necessarily want it outperforming. We do want it up off those lows. Remember the recipe, the ingredient, so to speak, for an S&P new swing high, but we don't want it outperforming. We don't want this leading the charge in the upward direction. It's not, so I'm not concerned about that. Your risk off sectors at the bottom are a non-issue. This is not, let's grab, instead of a pointer, let's grab an X. There we go. Non-issue here out of the risk off sectors. We've added a new chart to the risk on-off grid A. See if you can spot which one it is, and if you can answer what those tickers are before I tell you in just a moment, you are a champ. No, you're just very astute in your market analysis. So this is still risk on. This is still risk on. These have not deteriorated. This is still risk on. This is still risk on. So all set in the top 4. This is the ARK K, the Technology Innovation Fund, right? Relative to the S&P, still solid up here, looking like risk on, staying over the neckline of the inverted head and shoulders. This consolidation looks bullish to me. And the IWO and IWN are the new additions to this screen. I wanted a little bit more of a broad-based view of risk on and risk off. And if you know what these tickers are, then you will know that IWO is Russell 2000 Growth, and IWN is Russell 2000 Value. So this is growth versus value. It's very similar to the idea behind XLP, XLY, but it's an even broader scope of that, right? You're talking about the Russell 2000 index, the 2,000 companies there. You can see that this upward trajectory is very, very strong. So what would that indicate? We have a risk-on market on our hands, right? The next big step here is, can we make a new pivot high up and over this level there? Let's move along to let's grab our ratio B set, risk on off B. So this is now gold relative to the S&P, rolling over for a lower high. Looks fantastic. You have distribution look on the actual gold chart itself. We'll talk about that in just a second. Bitcoin continues to look good, but a little bit of weakness on the momentum here at the all-time high break. You're seeing, this is honestly a little interesting, right? Usually when Bitcoin's pushing the new all-time highs, the media is erupting, and maybe it's just social media, not the full, legacy media as they call it these days, but there's really no eruption and excitement and euphoria about the Bitcoin all-time high. I'm not saying that we need it for it to continue in the upward direction, but you'll notice, relative to gold, that's basically what this measures down here, Sailor Schiff, it is weakening ever so slightly in terms of the momentum and the follow-through. So I wouldn't be surprised if Bitcoin tries to produce a higher low. You could still easily, get sort of your Brigade bolt here over the 92,000 handle and maintain an uptrend on the weekly timescale. This is a weekly chart. My apologies if I butchered the timescale at an earlier reference. But daily down here for the TLT ratio to the S&P, clearly in a downtrend, starting to flatten out a little bit down here. But because of the way that this chart has developed in the downward direction, right? This is our scare around the tariffs. This is like, okay, things are going back to normal. The downtrend is resuming. This doesn't have to maintain as aggressive of a breakdown into perpetuity. A more mild, something that looks like this, something that looks like this, very reasonable out of this ratio. So I'm not overly concerned. The fact that it's on the lows is just more bullish in the first place. Let's take a look, or at least it speaks to enhanced risk appetite for equities. Let's take a look at the dollar. A little bit of an uptick here. Rates pretty stable. As we mentioned with bonds, if the TLT, so to speak, continues to get a bid, right, and you could use the 10-year note, the ZN, if you're looking for the bond future on that. If the ZN gets a bid, I would think that maybe this plays out as a little bit of a head and shoulders here on the daily time scale. The only issue with rates is that it's not even an issue, but it's an acknowledgement more so than anything else, is that the weekly chart is still producing, right? If you do this, this, and this, you're kind of stair-stepping up towards these equal highs. Are we just going to compress and then ultimately break out? That's the one concern from a technical perspective. I think there's many more mechanics here at play than just straight-up technicals on the not just the bond market in terms of the ZN, but the way that interest rates are perceived by the administration and the Fed and so on and so forth. So I don't know that I would take a classic technical approach to this, but that is kind of the threat from the higher time frame weekly, that this is absolutely a daily uptrend here. And if the range is going to retest the equal highs after suggesting higher lows, yikes. I mean, the concession has been, and we've talked about this for a number of weeks now, over 4.8 on the 10-year, you're probably talking about a breakout and rates go much higher, right? As an issue and a threat to the equities market. Let's take a look at the inverted, we'll look at gold just in terms of currencies. I know we were talking about the dollar just a moment ago, but this is looking more so like distribution. Not only do you have the relative strength line declining, but you also have these nuanced lower highs here as well. If you could break these lows more firmly, right? It's really this. Right around in here, just north of 30, what is it, 32.50? 32.20. If you could get under 32.20 an ounce on gold, you're probably talking about a retracement into this pivot low, closer to about 3,000 on gold. And once again, is that how the safe haven asset is going to act if everybody's throwing their hands in the air and panicking? Probably not. So the suggestion is lower out of gold based on this distribution look here, based on the relative strength line. I think that the panic, quote unquote, so to speak, is over on that flight to safety there. Let's take a look at the inverted ZT now and talk Fed, more so stable. nothing to really comment on, deep dive in that. We know that if we go back on over to the browser here, let's jump into our Fed Watch tool. No change on any of this. I think that if there's going to be any change this week in the actual metrics here, look at, we're still getting those 2 cuts. It's going to come tomorrow morning at the 8:30 time frame. We, of course, get the labor report, as in the weekly jobless claims and continuing claims, as well as on Friday, we get the PCE report, but I think the market's got a good grasp of that. Let's just jump over there now. You can see GDP, it's the second revision. I also think that's going to be a nothing burger on the second revision. The market should more so respond to the jobless claims if there's any big uptick there. And then PCE, which the market has a good grasp based on CPI and PPI in the previous cycles. I don't think there's going to be any shock here. So could there be a little bit of volatility in the pre-market around 8:30 on both days? Maybe, but I don't see it as a... There's nothing new here unless jobless claims are so unhinged to cause the market to freak out. And by unhinged, I'm talking about a read here that's over 250 on the week over week. Continuing jobless claims, initial, and then continuing would need a breakout as well. So those are the metrics to watch. We'll be live, of course, up in the office at 8. We'll be live at 8 o'clock as we always are, but we'll cover it live at 8:30 when the numbers are released, and we'll gauge the market reaction. Let's take a look at the earnings calendar. Of course, NVIDIA is the top dog after the close, and we'll get into a little segment on that after we just quickly rip through the calendar. Salesforce is the other interesting one, and then don't forget about Marvel and Costco on Thursday after the close. That's tomorrow, of course, worth paying attention to. Maybe Zscaler as well. A little hidden gem down there. Those are the honorable mentions. But the main point is to dive into NVIDIA. And if we take a look at the estimates from analysts, the average estimate here is the 0.75, that's earnings per share, so cents, 75 cents EPS. A year ago at 0.61, the average estimate for revenue at 43.25 billion. NVIDIA happened to beat both of those estimates, and you can see here year-over-year growth was, for Q1 basically is at 66%. They beat on both. So if we just take a look at the commentary, you can actually see that the revenue, and what we care about here is the gap. General accounting accepted principles or something along those lines. That's what we care about, not the non-GAAP forecast, although they did provide some insights into the China restrictions, which we'll get to in a second. But a beat on revenue, a beat on EPS as well. If you look at here, diluted earnings per share by a cent. So all set on the double beat. They also offered decent guidance. We'll talk about that as well. But in the non-GAAP, you can see that if they were not going to have... Basically, if they were able to sell it's a combination, right? So let's pause for a second here. You have to remember that NVIDIA paid a huge fine on some of the exports that they had already sent to China. They paid, I think it was a record $5 billion fine. And then I believe there was another one that came in at $4 billion. You can correct me in the comments. I'm not claiming to be an expert on the fundamentals of the company. I'm just trying to bring this back from memory. But the point is, if you take that out of how they calculate the EPS, they're, excluding the H20, the charge there and related tax impact, their EPS would have absolutely destroyed analyst estimates at 96 cents per share, which is incredible, right? Absolutely incredible. You can see that would have been even growth over the previous quarter, right? Not the year over year, but the previous quarter. So that to me is a pretty solid tell. If we can get through some of these China export restrictions, if there is any sort of negotiation that leads to a better deal with China, you're easily talking about an NVIDIA that continues to produce really solid numbers, as in if some of those restrictions are lifted. If they're not, it becomes a question of whether or not the UAE, which has already outlined, right, some of their expansion into AI, is going to make up for the China market. I would think not, just based on the pure size of the China market, but again, I'm not a fundamentalist. I'm going to look more so at the chart, but this is good context to have. If we do take a look at, let's scroll down here actually just a second. If we look at data center, the number was a little bit soft at 39 billion, but it was dramatically made up for by gaming. And when I say dramatically, I mean, obviously it's not nearly the same number as a figure, but look at the quarter over quarter growth on gaming relative to data center. Right, gaming grew at a very, very strong rate here versus the data center, which was not so much a growth component there. So not to say that it's going to become this big behemoth. The data center will always likely be the thing. but you're seeing some pull forward in the other categories, basically revenue by segment, that you weren't really seeing in previous examples, right? So that is what we've got on that. Let's move into the guidance, right? Revenue is expected to be at 45 billion plus or minus 2%, and that outlook does reflect the loss of the H20 revenue, which was scheduled to come in at about 8 billion due to the controls, right? So the original forecast and what the street was looking for, honestly, was closer to 53 billion in terms of guidance, but it is a good thing that Jensen acknowledges this in the outlook and sort of like reset expectations for the street headed into the next quarter. The other thing we can start to pick apart is margins. Margins did contract a little bit last quarter. Nothing I think that anybody is overly scared or concerned about. The growth story, of course, will come to a slowdown at some point, but for now, behemoth numbers from a behemoth company that everybody still loves. Let's get back on over to the platform here. Let's take a look at our remainder technical supporting evidence segments. Bonds relative to themselves, long end of the curve is still outperforming here, but notice how this is stabilized. It's a good thing that this has not gone on to produce these big highs. So far, so good out of the bond relationships. Let's move into credit spreads. They are continuing to yield lower highs on the break, or not the break. Well, it's a breakdown in the credit spread, but it's a gap up on the Tuesday session, right? These are lower and lower to start the week here. That's bullish. Remember, this increases risk appetite for equities. And of course, our HYG in isolation called the entire thing in advance. If you've made it to this point in the analysis, and again, it's one data point in the analysis. Don't get me wrong. I can't be contradictory here. I can't be a hypocrite. But the HYG, as we mentioned in the Saturday update video, was calling the bullish divergence. And notice how that ended up playing out quite nicely. So for now, back up towards the equal highs. It's kind of on par. They're trading in lockstep right now. There's no big divergence to mention. So we'll update you when it becomes relevant again. But so far, so good in terms of its reliability. If we're thinking about total breadth, you're seeing an uptick out of the moving average charts as well as new highs versus lows, producing a positive print thus far on the week. I would expect that to continue so long as NVIDIA provides this upward lift to the market. If we look at the RSP, you'll notice that we did not go much further on this pullback here. We're actually back over this previous pivot high, which is bullish at 176.15. If we take a look at the equal weight NASDAQ, these things are moving in lockstep. There's really not a big divergence to talk about on this. Maybe you could just say that this pullback got close, but it's not like it was a threat in the first place. Let's finish up with some volatility. VIX is trickling in the downward direction. I would imagine it continues to move lower on the heels of NVIDIA earnings. If you look at the VVIX, it's doing the same thing, right? Coming back down underneath that 103 handle. If we take a look at the volatility futures, they are in a strong contango. Remember that contango is where money managers like to allocate capital, and backwardation is where they're not. So if we're over the zero line, that is healthy in terms of new capital hitting the markets. If you want a simpler version, it could just be the 30-day VIX versus the 9-day VIX. And ultimately, what we're trying to describe here is the curve between current and future volatility. If we take a look at the actual curve, this convexity is good when it goes convex. It depends on which angle you're looking at it from. Convex, good. Concave, no good. Right? That's what we were dealing with in the wake of, what were we saying? Sorry, I'm drawing this at the wrong spot. It's if we were doing this, that would be no good. Higher risk in the present day versus the unknown future. Lower risk in the present day, the red curve, versus the unknown future holds higher risk. This is where money managers like it. And again, bottom line is that this is in a bullish position as of right now. Going back to this chart, though, I do want to acknowledge that into the afternoon, the one-day VIX did see a little bit of an acceleration here. I would imagine that the VIX, the one-day, crushes on the release of the jobless claims as well as GDP numbers tomorrow morning. With that, let's take a look at the core list of companies and see what's going on from this perspective. NVIDIA is up first on the chopping block. I was making note to remind myself about the H20 chip and the context there. I think we've already covered it, right? I did not tune into the full call from Jensen. I'm curious to know, and you guys can fill me in the comments section. I'll probably go back and watch it this evening. Was there any mention of like an alternate chip with a little bit less power or process? Don't quote me on the technicalities of chip and semiconductor design, but you get the idea. Was there a workaround chip that they can sell to the China market, and was that quoted? If we're looking at NVIDIA to start, what we should focus on is really the expected move from earnings, which was up here. It was about an $8 and what was it, 50 some odd cent move. $8, it was 54, 58 cents prior to the market close, like right at the market close was the read. So 143.36 and 126.28 are the two numbers. 140.35 is the current post-market read, and that would put us just inside of the upper bound of the expected move there. So option sellers are going to walk away from this one feeling good once again. Options buyers, if you're net long premium, you needed to move outside of that 143.36. It doesn't look like it's happening so far, but we'll see how foreign markets open up through the overnight session and respond to the news. If price can stay on a breakout and gap fill reversal, so we open over tomorrow, pull back any higher lows over the top end of the range here, qualifies as gap fill reversal for a bull flag breakout, and I would be looking for moves in the upward direction. Let's get a little bit more granular on the daily time scale with our levels back here again. That would be over 136.25, ultimately looking for follow through into this pivot high, right? So we open here around 140s. And then we pull back, gap fill reversal, target this. Of course, overnight high would be a target as well, and you'll just apply the classic gap rules, right? Let me come in here. Let me turn on the extended hours session for just a second, and I'll walk you through what I mean by that. So let's just say that we open here. If we get a rally that tests the overnight high, fails, and comes back down through the opening print, as you guys all know, we are looking for a full gap close. We are looking for a lower high under the open to trigger shorts. We can manage risk over that. So your stop goes here. Entry goes here, then your target is the gap close. That is a 3-to-1, 2-to-1, 2.5-to-1. It looks good. If this is not going to offer a clean enough lower high entry under the opening print, I would not say you can put a stop here, short the open, and then target this. That's about a 1-to-1. That's no good. Way too much risk involved in that. The better trade, and honestly where my data suggests that I trade the best, is the gap fill reversal. Rather than looking to short NVIDIA into the gap close, it's rather be patient. If we can support over the gap close, this long back to the opening print is more lucrative because it likely doesn't happen as fast. You're not panicked about the position, and it also gives the market a better opportunity to digest any of the positive news from the earnings announcement in the first place, right? You shake out all the people who chase it up here through the overnight, and then you allow stronger, more confident longs to get in on a gap fill reversal, which once again from the daily time scale would be supportive over the top end of the bull flag range right around in here. 136.25 is that number. So that's my take on NVIDIA. That's what I'll be primarily watching for tomorrow. If the market opens, consolidates, does not move underneath the opening print, you would have to be cautious of Brigade bolts over the overnight high 143.36. The expected move was almost perfectly hit. And you can also see here, very close to this pivot high. So if we can Brigade bolt over that, we open here, Brigade bolt over the overnight high, that's where things open up, 149.25, and then we're talking all-time high. Let's keep this thing moving along. I'm just going to reset this so my hourly chart is back to where it should be. Then we'll go over to Microsoft. You're going to get a little bit of sympathy here. Obviously, a lot of names are higher in the after hours right now. 461, let's just call it. That's going to bring us right into the high of today's session. Microsoft's daily chart is ugly. The hourly chart is fairly ugly. It's looking like a look above and fail here, but with the open at 461, we're back over the level. It's been really tough, in my opinion, to trade some of these names, and we'll get into some other ones here in just a second. I would really just focus on the 458.75. Do we open above, stay above? Can we target the equal high at 462.65? Or if we get back down under that level, is there some way to close the gap if we unwind any of the relative strength from the NVIDIA sympathy open? So the setup is not so clear, in my view, out of Microsoft. The daily has been a slow grind in the upward direction. This is always dangerous because what it ultimately suggests is that buyers are not really rewarded in sort of an instant sense. I mean, maybe a little bit so on this larger up day here, but anybody who's longing this near the highs is like, okay, now we got to sit through some drawdown. Okay, we're back to green. Okay, we're back to red. We're back to green. We're back to red. It's disappointing for more traders than it is rewarding. You're not seeing like a straight up move and then some consolidation via pullback where people take profit, so on and so forth. So it's like a ticking time bomb. You could think of it that way almost. That's Microsoft in a nutshell. That's my view on it. I'm really not fond of this daily structure and the consolidation here. So instead of harping on it, let's move along to Apple, which is just in a balance range here. Here's the midpoint of the range. A little bit of sympathy, not much in the after hours. 201 is still the key over or under level. I think that the daily bar is actually setting up more of a possibility for a short back down to the equal lows at 193.75. If we can reject and break down underneath today's low, something like this, remember that your daily bar is an inverted hammer that looks like this, right along those lines. So we open here, right? Brigade bullets there easily bring in sort of this follow through to the downside. And because Apple at 201 is rejecting the 90-day pause high from back here, I would maintain more of that bearish stance, right? This is kind of a Brigade bolt here in the lower third of the balance range that we're trying to navigate. So shorts on Apple seem reasonable if the broad market's pulling back tomorrow. Let's move along to Nancy. Another one that's just kind of chopping around in a balance range. The only thing going for it is that the consolidation is giving an opportunity for sort of a sloppy inverted head and shoulders. Amazon, a little sympathy to NVIDIA here, the whole AI play, of course. For over 203, I'll give the buyers the benefit of the doubt. I'm not fond of how the market looked into that overhead gap and failed on this morning's session. I would like some more firm acceptance in that. So next long trade is really acceptance over 206.50s. If we can get some follow through in the upward direction, maybe we're talking about a retracement up towards that 213.25. But inside of this range, hard-pressed to really make a bold call, really neutral and balanced until proven otherwise, here or here. Let's take a look at Google, another chart that's just been kind of irritating in this range over here. The IO news had it all over the place, could not really make up its mind if it was going to yield that firm high or low or not. On the balance day here, quick breakout, very, very difficult to trade. It was still technically under the daily 200. Just another one of those charts that I don't want to harp on too much negativity. If anything, it's just a signal to maybe take it slow, be very patient, look for a solid setup, make sure you can manage your risk on these names, and don't just throw darts. If you're just throwing darts and you're like, the chart sucks, but I feel like I got to do something, that's a signal to maybe dial it back a little bit and just wait for a little bit more clarity. And if you're seeing these charts clearly, if you're like, wow, I've been crushing it on Google this week, this is the best thing in the world, great, all the power to you. But my chart vision right now for Google is not really something that I'm all that thrilled about. If Google is going to make a move to the downside, which again, after hours, it's not looking likely, it would have to be here, right? Thin structure retracement through that gets interesting. That's 168.50. If it's just noodling around in here, I'm just like, not interested. Metaverse, a little bit cleaner in the sense that it's trying to find this higher low over the top end of the balance range. That's 641.75. If we can get it, the ideal rotation would be up towards this local high at 661. Watching out for that. Obviously, some sympathy to NVIDIA. 648.50s in the after hours brings us to just a hair over the intraday lower high. If you wanted to have, let me actually remove this real quick. If you wanted to have a helper level, I would probably adjust it to here, 46.65 or 46. What do we have? 50, let's say. 646.50s. Let's make that dotted dim as we typically do. There we go. Consolidation, Brigade bolts above probably gets you involved, or an open above that supports above. That's your helper level. That's how I'd look to trade this out of Meta. I would also still be very open to just pullbacks into directly the 641.75 level coming from all these previous examples back here. Really not favoring shorts on Meta until we either make it to the equal high for a pullback, maybe something along those lines, or if it gets back down into this range, Brigade bolts for look above and fail, right? Something along these lines from A to B would be the trade. Let's move along to Tesla, a fan favorite recently, and for good reason. Really solid breakout on the Tuesday session. I think everybody and their brothers, mothers, sisters, goldfish caught that trade. Kudos. Let's continue to get the job done. As long as we're over 349, I think we're looking good. Now, in the after hours, you're already higher at 362.40 by 30, give or take. So that's kind of right around in this zone right here towards today's highs. So I don't know that you're going to get the full retest of 349. If you do get there, the Brigade bolt is certainly in play. I would be looking for longs off of that level, or consolidation in this bull flag from the hourly perspective unlocks upside over 363 with acceptance into 377 as the next major overhead target. So Tesla is a top watch. I would say Meta is a top watch. So these two here. NVIDIA will be a top watch simply because earnings will be out. A reminder that the IV crush might last the first 5, 10, 15 minutes, but after that, it's fair game for the Friday expiries, if not just next week's expiries. We'll move along to JP Morgan for financials looking pretty solid and stable here, so long as higher lows persist. Over 262.25 looking good for the inverted head and shoulders. As follows, getting follow through to the upside is bullish for the broad market. Netflix is up last on the core list of companies. New all-time highs today, but not really getting follow through in the upward direction. No sympathy on the NVIDIA move, so this is a wait and see trade. If we pull back to here, hourly high or low, Brigade bolts to the upside play. If you want shorts, it's still a patience play for this. Thin structure retracement off to the left would have to be underneath 1183. Let's get into two trade ideas for you, and then you're on your way. The first one is on CRWD for CrowdStrike. And the idea here is twofold. We talked about this in, was it last weekend's update or the Wednesday update? I can't even, I'm getting them all tangled up. Earnings next week, so you get the Friday expiries just fine. Bullish 3-bar play on the daily time scale. The hourly looks like a bull flag there. Brigade bolts over 473.25, unlock blue sky territories, or if CrowdStrike pulls back, if the broad market is weak tomorrow, I'm very interested still in the Brigade bolt concept here over the previous all-time high at 455.75 all the way down to 450, the top end of this consolidation range there. Let's go to the hourly so you can see this. Here's your Brigade bolt to the upside over 473.25. Consolidation in here, let it be, it's fine. If it pulls back, I'm interested in long opportunities on, heck, inverted head and shoulders, double bottoms down here, simple hourly hammer candles, whatever it might be around this zone. So that's CrowdStrike. The next one is on SBUX. SBUX is the ticker there, of course. And if we go to the daily time scale, you can see really thin structure retracement off to our left. And notice the pressure at the daily 50, the equal highs, the tariff pause highs at 87.60. If we can get over that, the next major target really comes from the opening print of this bar in here. Let's go 93.50s on that. And let's make it yellow because in reality, there's just a gap above. Right, your gap above is into this green bar's low. Let's see if we can't round off here as well. Let's try the 97.25s. Good. And then we'll take a look at the hourly. Ideally, this builds out. Sorry for the funky zoom. Ascending triangle, right? Zoom in again. Let's try. Oh, come on, Thinkorswim. Come on, play nice. Let's try it one more time. There we go. Ascending triangle, higher lows persisting over, I would argue, in here at 84.80s. Keep this trade idea in force. And then ultimately our breakout is some kind of Brigade bolt here at 87.60s. Okay, that's what I've got for you in today's Wednesday midweek market update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that 5,000 likes on a pre-market prep show will get you an unlocked picture of the brass abacus. We are still yet to do it, and we've been far, far off every single time. Reminder, as always, we'll be live 8 o'clock Eastern time for tomorrow's pre-market prep, and it'll be a special one because we get the GDP numbers as well as the jobless claims. PCE on Friday. We will have coffee and donuts up in the office on me. With that said, have a green trading week, and I will see you in the next one.